At the heart of the property market, there is a paradox. Prices are still rising in most centres, and auction clearance rates remained elevated. Yet, mortgage lending momentum is easing. How can this be? Welcome to the Property Imperative Weekly, to the 15th of July 2017. Hi, I'm Martin North, Principal of Digital Finance Analytics. In our latest weekly review, we look at lending momentum, property prices, and mortgage industry innovation. We're living in turbulent times. First, don't believe all the noise about home prices collapsing. Latest data shows continued growth. For example, in Victoria, according to the RIEV, the metropolitan Melbourne median house price rose 2.9% in the 3 months to June the 30th to $822,000. The top growth suburbs were spread right across Melbourne and at both the low and high ends of the market, from Broadmeadows and Roxburgh Park in the north to Malvern East and Toorak in the southeast. Croydon in the outer east experienced the city's largest quarterly increase, and it was up more than 20% to a median of $810,000. Toorak was the most expensive suburb. Half of the top growth suburbs are priced below the median, suggesting buyers continue to seek value further from the city. Melbourne's apartment sector performed similarly well in the June quarter, with the metropolitan Melbourne median apartment price increasing by 4.3% to $606,500. House prices in regional Victoria rose strongly for the second consecutive quarter, up 2% in June to a record high of $385,000. Data from CoreLogic also showed that to the 9th of July, prices in Sydney rose 3.4% in the past month. In Brisbane, they rose 0.5%, but they fell in Adelaide by 1% and Perth by 0.8%. In addition, the preliminary auction clearance rates increased to 70.7% this past week, which is up from 67.3% the previous week. Even though auction volumes fell week on week, there were 1,751 properties taken to auction this past week, down from just over 2,000 last week, but still higher than this time last year. All but two of the capital cities saw the clearance rates increase week on week, whilst Melbourne recorded the highest preliminary clearance rate at 73.9%. But there are a number of clouds on the horizon. This week, the government released draft legislation stemming from the 2017-18 budget, when the Treasurer said travel expense deductions relating to residential investment properties would be disallowed, and also depreciation deductions for plant and equipment used in relation to residential investment properties would be limited. We released our Household Finance Confidence Index to June 2017, and the news was not good. Overall, the index dropped below the neutral setting and appears to be trending lower. The current reading is 99.8% compared with 100.6% in May. The fall is being driven by a confluence of issues, none new, but now writ large. Households are seeing the costs of living rising, especially power costs, childcare costs, and council rates, whilst household incomes remain depressed and are falling in real terms. Returns on deposits actually fell as well. So mortgage repricing is not being matched by better saving rates. The costs of mortgage repayments rose. The most significant fall in confidence was in the property investment segment, where loan repricing has been more pronounced, whilst rental incomes are hardly growing. They are also concerned about slowing capital appreciation. However, it is still true that property owners have their confidence buttressed relative to property inactive households, who are more likely to be renting and see no rise in their overall net worth. The ripple of mortgage rate rises continued, with Advantage Edge, an important wholesale funder and distributor of white label home loans and part of the National Australia Bank Group, announcing that it will increase the interest rate on all new and existing variable rate interest-only home loans by 0.35%, effective from the 8th of August. Westpac said it was ditching some mortgage and equity release products in a high-level review of its product range and underwriting standards. The latest products to be dumped include equity access low documentation loans, which is a revolving line of credit secured against property, and a range of fixed-rate low documentation home loans. The review recommendations are expected to flow on to the Bank of Melbourne St George and Bank SA. Data from the Australian Bureau of Statistics showed that overall lending finance sagged in May. Owner-occupied housing grew by 0.4%, with a rise in first-time buyers, but all other lending flows were lower, whether you look at the trend or seasonally adjusted figures. Personal credit continues to fall. The flows fell 3.2%, with similar rates of decline across both fixed and revolving loans. Total commercial lending fell 0.8%. Within that, lending for investment housing fell 1.5%, whilst other fixed commercial lending fell 0.5%. Revolving commercial credit fell 0.3%. If business confidence is really as strong as has been previously reported, then why is there no growth in borrowing? Something just doesn't add up. As a result, the total proportion of business lending to total lending stood at 29.9%, which is down from a 30.9% peak in December 2016. The proportion of investment property lending flows slipped to 18.1% of all lending and 37.4% of all housing lending. So whilst the regulatory tightening is crimping demand for investor finance, it has not been replaced with a rise in productive business lending. So commercial finance has fallen. And this will put downward pressure on growth at a time when mortgage interest rates are rising. We cannot see how the future growth expectations from the RBA are going to be met on these figures. It is clear, however, that secured lending for owner occupation rose as first-time buyers picked up the slack, and investor lending remains strongest in the two overheated markets of Sydney and Melbourne. Much of the fall in investment sector lending resides in the other states, and in those states they already have other economic pressures. Data from AFG also showed that more new loans were being written by non-major banks, who are helping to fill the void left by some of the majors, and consumers are benefiting from the fact that a mortgage broker can offer products from these lenders without a branch network. All this explains why we have home prices moving up, whilst lending is slowing. You really need to get granular to understand what's happening, as discussed in an interesting IMF working paper released this week. Elsewhere, mortgage broker commissions were in the spotlight following the ASIC review, which found that consumers were not getting great outcomes and that the standard model of upfront and trail commissions creates conflicts of interest. The industry is being given a chance to self-regulate, and so a combined industry forum, which involves the ABA, MFAA, FBAA and COBA, first met in June and is scheduled to meet again this month, with a broad objective of responding to ASIC's review. Participants, though, hold a wide range of different views on what should be done. Separately, Choice said it was simply not good enough that ASIC has left it up to the industry to find a solution to broker commissions. They suggested that the way mortgage brokers are currently paid means that it is very unlikely that the consumer is going to get a loan that's best for them. And they said that the industry needed a major change. Backing this up in a joint submission to the Treasury, Consumer Advocacy Group Choice, along with the Financial Rights Legal Centre, Consumer Action Law Centre and Financial Counselling Australia, called for the removal of upfront and trail commissions, the implementation of fixed fees via lump sum payments or hourly rates, the removal of bonus commissions, the removal of bonus payments and soft dollar payments, and to change the law so that brokers have to act in the best interest of clients. And finally, a requirement that brokers should disclose ownership relationships and the lender behind any white label loan recommended to a consumer. However, the peak bodies, the MFAA and FBAA, have called this submission ignorant and misinformed, which perhaps is unsurprising as these bodies are strongly aligned to the current mode of operation. They slammed the recommendations as detrimental to consumer interests and claimed mortgage rates would rise if such reforms were implemented. We're not so sure that that's the case. The Australian Bankers Association announced that it wants commissions to be decoupled from loan size, but it is prepared to negotiate with brokers to find a new commission model. Their CEDGIC review called for commissions to be completely decoupled from loan size by 2020. So there will be some changes to mortgage broker commissions, but it is not yet clear what the shape of these reforms will be. Whilst consumers say they get good service from brokers, the implicit conflicts in the current model cannot be overlooked. Finally this week, two interesting fintechs launched, and they highlighted that innovation is set to disrupt the mortgage industry further. TikTok has emerged, offering instant home loans through a digital real-time loan processing system that they say connects customers directly to lenders, and they claim a 22-minute home loan is available, which includes approval and document generation. This is significantly faster than most traditional lenders and could be very disruptive. Separately, peer-to-peer lender Zaga held a launch party in Sydney recently. The firm is looking to differentiate itself from competitor peer-to-peer players by pitching itself as the secured alternative. All Zaga loans are secured against a property and investors are matched with a specific loan, so it's not a pooled structure. While an algorithm is used to match investors with borrowers, depending on each investor's risk tolerance, each lender undergoes a credit assessment by Zaga's staff. So, signs of digital disruption hitting the mortgage industry in this time of uncertainty. And that's the Property Imperative week to the 15th of July. If you found this useful, do subscribe to get the next edition. Sign up to the Digital Finance Analytics blog to receive all the latest news. And thanks for watching.